Market makers are the hidden facilitators behind every stock trade you make. When you buy or sell a stock through your brokerage app, have you ever wondered who is on the other side of that transaction? The answer is often a market maker. These financial intermediaries play a crucial role in ensuring that stock markets function smoothly and efficiently. Understanding how market makers operate will give you valuable insight into how the stock market really works behind the scenes. A market maker is a financial firm or institution that stands ready to buy and sell specific stocks at publicly quoted prices throughout the trading day. Their core function is to ensure liquidity in the market. What does liquidity mean? It means that whenever you want to buy or sell a stock, there's someone available to take the other side of your trade. Without market makers, you might have to wait hours or even days to find another investor willing to buy what you're selling or sell what you want to buy. Market makers eliminate this problem by always being available as a trading counterparty. Market makers operate by continuously quoting two prices for every stock they handle, a bid price and an ask price. The bid price is the price at which the market maker is willing to buy the stock from you. The ask price, sometimes called the offer price, is the price at which they're willing to sell the stock to you. These two prices are always displayed together in trading platforms. For example, you might see a stock quoted with a bid of $99.90 and an ask of $100.10. The market maker stands ready to execute trades at either of these prices instantly. The difference between the bid price and the ask price is called the bid-ask spread, and this spread is how market makers earn their profit. Let's look at a concrete example with stock XYZ. Suppose the market maker quotes a bid price of $99.90 and an ask price of $100.10. The spread here is 20 cents per share. If an investor buys 100 shares at $100.10 and another investor sells 100 shares at $99.90, the market maker pockets 20 cents per share, or $20 total. This spread compensates them for the service they provide and the risks they take. Market makers provide three critical benefits to everyday investors. First, they enable instant execution. When you place a market order to buy or sell a stock, it executes immediately because a market maker is there to take the other side of your trade. You don't have to wait for another individual investor to match your order. Second, they provide market liquidity. This means there's always someone willing to buy or sell, which keeps the market active and functional. Third, they contribute to price stability. By continuously buying and selling, market makers help reduce extreme price swings that might occur if trades were sparse and irregular. These three benefits make investing more accessible and reliable for everyone. While market makers profit from the bid-ask spread, they also face significant risks. The first major risk is inventory risk. Market makers hold large quantities of stocks in their inventory, and if those stock prices fall before they can sell them, they incur losses. The second risk is adverse selection. This occurs when they end up trading with investors who have better or faster information about a stock's true value. For example, if insider news is about to break, informed traders might sell to the market maker right before bad news hits. The third risk is market volatility. During periods of rapid price changes, market makers can suffer substantial losses as the value of their inventory fluctuates wildly. These risks explain why market makers need that bid-ask spread as compensation. Several major firms dominate the market-making industry. Citadel Securities is one of the largest market makers in the world, handling billions of trades daily across multiple asset classes. Virtu is another global leader specializing in electronic market making using sophisticated technology. Jane Street is a quantitative trading firm that provides liquidity across various financial instruments using mathematical models. Two Sigma is a technology-driven market maker that relies heavily on algorithms and data science to execute trades. These firms employ advanced computer systems and highly skilled traders to manage the complex task of market making across thousands of different stocks simultaneously. Let's recap the essential points about market makers. First, Market makers provide the essential liquidity that enables smooth and efficient trading in stock markets. Without them, buying and selling stocks would be much slower and more cumbersome. Second, they earn their profit from the bid-ask spread, which is the difference between the price they buy at and the price they sell at, while simultaneously taking on significant inventory and volatility risks. Third, and most importantly, market makers are the invisible facilitators that keep financial markets functioning efficiently every single day. The next time you execute a trade instantly on your phone, remember that a market maker made that possible by standing ready to be your counterparty.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.